Arrange the following acts in order in which they came into force. So when we're talking about the dates, the Monopolies MRTP Act, Indian Contract Act, we know this is 1972. The Sale of Goods Act is 1930 and FEMA Act is 1932. So the correct order, of course, is going to be, it's going to start with Indian Contract Act, then it's going to be Sale of Goods Act, then the Foreign Exchange MRTP Act, and then finally FEMA Act, that is the Foreign Exchange Management Act. The MRTP was actually replaced by the Foreign Exchange Management Act. Okay, so that is why first Monopolies Restrictive Trade Practices Act, and then comes the Foreign Exchange Management Act. So B, C, A, D should be the correct order. Next question is an assertion reason based question. It says, assertion says, industrial policy of 1991 initiated liberalization of the Indian economy. Absolutely correct. Industrial growth was very slow before 1991. Absolutely correct. Now, if you talk about the explanation, is it true? Is it supporting the explanation? Yes, because both industrial policy and industrial growth, when we're talking about the industrial policy of 1991, which started with the liberalization, okay, it started to reduce the the regulations and the trade regulations that actually introduced the policy of that was introduced by the policy of liberalization, and it was very slow before 1991. Which of the following is not an objective of planning? Economic growth, setting of heavy industry, modernization, or none of these, which should not be the objective of planning. Setting of heavy industry is not an objective of planning. When we're talking about economic growth, yes, it was obviously an objective of planning, and modernization when we have read the 5-year plans. Setting up of heavy industry was never in the plan. Again, an assertion reason question. Assertion says a ratio analysis is one of the tools employed to know the financial health of a concern. Absolutely correct. Ratio analysis is not the only a technique available to take investment decisions. This is also true. So both assertion and reason are true, and R is the correct explanation. Ratio analysis is one of the major tools which is employed to know the financial health. Okay, it helps in knowing the liquidity position. It helps in knowing the profitability positions, the investment positions, what is the financial health of the organization. Absolutely correct. And ratio analysis, but is not the only technique available to take investment decisions. There are many other techniques, okay, like the cash flow analysis, the fund flow analysis, which helps in taking up these decisions. So the correct answer is both assertion and reason are true, and reason is not reason is the correct explanation of A. Okay, so we have been given current capital, working capital as 60,000. That is CA minus CL. That is the current assets minus the current liability is 60,000. Current ratio also we have, that is a CA by CL. That is 2.5 is to 1, and liquid ratio is 1.5 is to 1. So we'll be getting two equations on the basis of the current ratio and on the basis of the liquid ratio. When we calculate on the basis of these two equations, both on CACL, we are going to get the value of stock as rupees 40,000. Correct answer is going to be 40,000. Which of the following are the qualitative characteristics of financial statements? When we're talking about qualitative, okay, relevance, reliability, comparability, and understandability. Of course, relevance is important. Reliability, comparability, and I think the correct answer should be A, B, C, D. Yes, the correct answer is all the four. That is irrelevance, reliability, comparability, as well as understandability. All these four are the qualitative characteristics of the financial statement. Relevance means a particular financial statement should be relevant according to the time period to which it is pertaining, according to the goods that the information that it contains. Reliable, it should not be there should not be any lies in that. It should be comparable between different financial periods and between different organizations as well, and it should be easily understandable. Hence, all these are the qualitative characteristics. Okay, again we have an assertion reason question. Assertion says under diminishing balance method of depreciation, charge for depreciation keeps on diminishing year after year in all subsequent years. 100% correct. Under diminishing balance method, the rate percent at which depreciation goes up diminishing from year to year. When we're talking about the rate of depreciation, so A is correct, but R is not correct. When we're talking about the rate of depreciation, it does not go to decrease. It actually starts to increase, okay, after a certain period of time. So the depreciation value goes on decreasing on the diminishing balance method, but the rate percentage, it does not change, it does not decrease. Next question, in case of installment payment system, the ownership is transferred from the vendor to the purchasee immediately on the payment of the last installment, on the recovery of goods, or on the payment of the insurance payment. Immediate. It is immediately transferred. The ownership is immediately gained from the vendor to the purchasee. However, The purchaser is given time, sufficient amount of time to make the payment, to make the installment payment, by which ultimately the good is going to become in the hands of the purchaser. But the payment is the ownership is going to be given immediately from the vendor to the purchaser. Next question says, on admission of a new partner, balance of profit and loss adjustment account should be transferred to the capital account of all partners in the new profit sharing ratio. Of course not. Why? Because this portion of profit and loss adjustment is not pertaining to all the partners. It is pertaining to the old partners. All partners in the old profit sharing ratio, absolutely correct. All partners in the new profit sharing ratio, no. All partners in the sacrificing ratio, no. The correct answer should be all partners in the old profit sharing ratio, because this portion of profit or of loss or the reserves or the provisions are all pertaining to the old partners and should be divided in the old ratio.